To me, that's the key number today.
It is, and one we're going to be watching very carefully, Tom. Has inflation peaked, or was it going to be like inflation was transitory and we quickly learned it wasn't? My question is, if it is hot, can the Fed wait until September 21st? That is still a long way away.
That's a really interesting question. I mean, it's September, that bears study, that bears conversation. We'll do that with David Stubbs here. Futures up 8, the VIX 22.34. This is Bloomberg. Stay with us.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
From New York City,
in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
For the Fed right now, it actually might be easier for them to continue to attack or at least try to bring under control this inflation issue.
The Fed is open-minded, as the Fed always is.
We are at an important inflection point in the inflation story.
If you look at the 25% decline early in the year, I think that was the baking in of a mild recession.
The economy is not out of the woods.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Bramlett, and Tom Keene on radio and television. A most historic Wednesday here on inflation in 90 minutes. Caitlin Lyons in for John Farrow this morning. And Lisa, let's get to this so we can get to David Stubbs. The answer is nothing else matters except 8:30.
That's pretty much true. I mean, honestly, we're looking at markets and they're trying to find direction and they're kind of lackluster because why trade ahead of something that could fundamentally shift the conversation? You highlighted just a moment ago, Tom. Are we talking about 50 basis points? Are we talking about 100 basis points? What is the differential in the Fed trajectory after this print that we get at 8:30?
A more optimistic tack coming up in moments with David Stubbs of JP Morgan. Kayla, your observation if you look at the research overnight.
I'm watching the yield curve, Tom. We're already inverted by nearly 50 basis points. If we get a hot inflation print and that raises expectations of the terminal rate, Bank of America is saying we could go as low as -85. How much deeper can the inversion get?
I have not seen that. I know Ian Lincoln at BMO Capital Markets modeling out -50 out to -56 basis points. -85 basis points is on the edge of Volcker as well. Let me do the data check right now so we can get to Mr. Stubbs. Futures up 8, Dow futures up 66. The VIX really showing the range bound 22.30. The two-year yield is stunning 3.27%. That's the number to watch at 8:30 this morning. The market watch off of what we see. Oil gives back off some pipeline news out of Ukraine, out of Russia, 89 on West Texas. Brent crude, $95 a barrel. Dollar churn slightly weaker as well. We need a briefing. It'll be knee-deep in 3- and 10-year auctions.
Oh, yeah.
Here's Lisa Bramlett.
It'll actually be knee-deep in the one story of the day, which is 8:30 a.m. We get U.S. July CPI. We're going to be talking about the headline figure, the expectation being by the survey 8.7%. We're going to be talking about the core figure, expected to come in at a faster pace than the other, the non-core elements. I'm talking about real wages, which have continued to decline and are about -4%. This is the decline in the disposable income of individuals as they go around based on how much inflation is outstripping wage gains.
This is absolutely the most important chart up. For those of you on radio, all you need to know is it's reality for 10 years, and then there's some pandemic noise. In the so-called integrand, Lisa, the amount, the duration of pain is really adding up.
And you're seeing that on the margins at places like Walmart, at places like Target. You're seeing that with anecdotal evidence of people transitioning away from higher cost items to lower cost ones. You are seeing the most negative real wages going back to at least 2007. Yeah. At 10:30 a.m., the one reprieve has really been oil. And you talked about the decline today on the heels of the resumption of flows. We do get the EIA latest oil inventory report for the United States. How much does this give a sense of perhaps a build in inventories or a lack of demand? We saw a little bit of evidence yesterday suggesting that. However, a lot of people have called that into question, and this really does underpin how far that headline inflation print can keep declining. And today, Fed officials will come out and they'll talk about that CPI report. Don't call it forward guidance. I don't know what you want to call it, but we're going to hear from Chicago Fed President Charlie Evans at 11 a.m. and Minneapolis Fed President Neil Kashkari at 2 p.m. alongside BlackRock's Larry Fink and Larry Summers, the former Treasury Secretary, who's been very outspoken, Tom, about how this Fed has been behind the curve, how they haven't been exactly upfront with what they're looking for in terms of inflation, in terms of how high unemployment will have to get, and how quickly that rate can come down, and how much pain the economy might have to suffer.
Let's do this now. We're going to get to the inflation questions with Lisa and Kaylee. But right now, someone who gave me my essay of the summer 12 months ago, David Stubbs out of LSE and New School of Social Research, wrote an incredibly prescient piece last year on technology. He joins us from JP Morgan Private Bank. I want to do a segue here into inflation, but the technology of the moment, which defines, as you said last summer, the haves and the have-nots of the American economy, they're affected differently by inflation. The technology winners are not as hurt as the technology losers.
Absolutely, Tom. This has been one of the key drivers of the growth in wealth inequality, income inequality in the U.S. and across most of the developed world, for sure. And certainly when you are faced with such a major inflation push in the core necessities of food and gasoline and rent that we are seeing, and we're going to see again in just a short while, it absolutely lays bare some of the weaknesses and some of the fragilities of the majority of the working age population in the developed world.
You got 4 weeks left in the summer. I said to Joyce Chang, be sure Stubbs writes a decent thing on technology here before the end of the summer. Lisa?
Well, perhaps technology, but also perhaps Goldilocks.
Goldilocks. We all love that story. And you see, David, the potential for a Goldilocks type event if you get a miss in the CPI print. If it comes in lower than expectations, then you could see a surge in the S&P. Can you explain that, given that so many people see the risks as the other way, that there won't be that much of a move in markets because people have already priced in the pivot if you get a downside surprise, but an upside surprise will start to really incur some pain?
Yeah, Lisa, let's be very clear what this is. This is a discussion of markets over the summer. They tend to be thin, they tend to be a little volatile, and the market is desperate for some kind of hard evidence that the inflation surge is lessening and the Fed won't have to do as much as some people fear, and that the soft landing is likely. And if that is the message from the coming CPI report, absolutely you could see risk assets rally very significantly today and probably back it up tomorrow as well. But these are short-term moves for sure. Ultimately, we do see a lot of downside in the equity market if we do get a recession. And as your previous guests have been discussing for the last hour and a half or so, the message from the CPI report is probably going to be core sticky inflation around things like rents continuing to accelerate even as headline pulls back. So we are entering, I think, a new phase in the inflation debate, one where key drivers of the last 9 months or so around food and energy start to reverse a little bit. But ultimately, the Fed focuses on core more than headline. And the core message from core is still going to be worrying, and it's still going to mean the Fed's going to do a lot more in the 3 meetings it's got throughout the remainder of this year.
David, is it fun to be a strategist right now as you try to game out all of the potential ambiguities and try to come up with what people should do with their money?
It's always fun to be a strategist, Lisa, because there's always a lot of interesting things going on. But we have been through a whirlwind of a cycle. I mean, we see clear evidence at the moment of late cycle behavior. Look at unit labor costs you were referencing earlier. Look at the lack of labor supply growth. Look at obviously the acceleration of inflation and wages. Only 12 months ago, 18 months ago, we were talking about early cycle conditions. So we are still in the shadow of COVID, and it is throwing all kinds of traditional relationships out the window, making it very difficult for all market participants, not just strategists. Yeah.
Okay, well, which one is more confounding, the equity market or the bond market?
I think the equity market rally has gone a little far, for sure. I mean, there's so many items of evidence that the global economy is slowing rapidly, that corporate earnings are going to come under pressure from margins. And the message from the bond market makes a lot of sense, and that is that central banks are going to have to do a lot more, that they are credible, that we have an inflation targeting independent central bank framework that's going to do what it's designed to do, which is bring inflation back down to target, but it's going to have to flirt with recession at the very best outcome to do so. And that is why you have the very significant curve inversion you've been discussing about. And it looks set for me for that kind of curve inversion to get even larger as we move into the fourth quarter. Evidence of slowdown continues to stack up, and yet central banks have to continue to hike rates.
Yeah, and that's the camp that Bank of America in as well. And of course, the reason that the curve is inverting is that we've seen the short end move substantially higher, and we're seeing yields come in at the long end, which in theory, David, lower yields should be somewhat supportive of equities, specifically those that are in the growth realm. Is that still a good thing if the reason yields are lower is because growth is slowing down?
Well, I think mechanically, of course, interest rates help with the discount rate, and anything that's a growth asset with the earnings that are way out into the future gets impacted. And certainly, we've seen growth outperform value since mid-May, and two things caused that, I think. One is that you saw jobless claims start to rise, and that was the first sign that, hey, like the economy and the labor market really is starting to show a few cracks around the edges. And also, you saw that move in interest rates, and that's what boosted growth. Now, of course, if the interest rates keep going down, it's probably not because the Fed is credible and they're getting a handle on inflation. It's because the economy is sliding into recession, and that shouldn't be good for any part of the equity market.
Let's go to the geometry taught at the London School of Economics about smooth glide paths, as the great Peter Orszag puts it. Do you perceive the descent of core inflation into 2023 is a smooth, measured glide path, or do we move down and pause? Move down and pause?
Well, I think firstly we're going to continue to go up in the coming months, Tom. But absolutely, you'd love to think that when we get to the fourth quarter, the course starts to decelerate suddenly year on year, and then that glide path is reasonably smooth.
Driven by goods disinflation?
Driven by goods and also eventually moving into services. Look, services ex energy, which includes rents, is the really worrying part of inflation right now, and the Fed needs to see that roll over. It's not going to roll over for a good few months yet, but it should do is going into next year, as your question lays out. What is I think the big debate, and quite scary in some ways, is you could get inflation coming down to, say, 4% annualized in the first quarter of next year
and then
stay there. That's the issue.
I totally agree with this.
Because that's certainly a good possibility, and that would prevent central banks around the world from cutting next summer, cutting the end of year, whatever, whenever you want to assume that they'd be able to cut.
I'm running out of time.
If you have a recession.
This is brilliant, David. I'm running out of time. To be clear, you're saying services, X-energy, X-shelter is what the sub-index you're watching.
Well, services at X-energy is almost 50% of CPI, so that's the one that's straight away. You absolutely want to focus on shelter. Also, things like hospital costs. Sometimes you take that out to get a core measure. But Tom, if you start removing too many things, it doesn't make any sense. Services X-energy is what I'm focused on.
Dr. Stubbs, don't be a stranger. David Stubbs of J.P. Morgan giving a fabulous brief this morning here on inflation. Equity markets with a little bit of a bounce. I'm not going to oversell it. Futures up 11. NASDAQ goes out up 0.3% as well. The VIX 22.25. Please stay with us again in our next hour. Michael McKee will prepare you for the inflation report.
Keeping you up to date with news from around the world with The First Word, I'm Ritika Gupta. What's been called the most scrutinized economic report in the world comes out this morning, and it will give us a sense of where the fight against soaring inflation in the U.S. stands. According to a Bloomberg survey, the Consumer Price Index probably increased at an annualized rate of 8.7% in July. That is down from June's figure, but still way above the Fed's 2% target. The CPI is out at 8:30 a.m. New York time. And in New York, former President Trump says he will be questioned today under oath about his dealings as a real estate mogul. The investigation involves claims that the Trump Organization misstated the value of its prized assets for tax reasons. That comes just 2 days after federal investigators searched the former president's home in Florida. Republicans echoed the assertion that the search was politically motivated. China has ended those unprecedented military exercises near Taiwan, but it says it plans to conduct regular patrols in the region. The Chinese began the drills last week after U.S. House Speaker Nancy Pelosi defied Beijing and visited Taiwan. Elon Musk has sold $6.9 billion of stock in Tesla, his biggest sale ever. The world's richest person says he wants to avoid a last-minute sell-off of the carmaker's shares in case he is forced to go ahead with his deal to buy Twitter. Musk says he'll buy Tesla shares again if the deal doesn't close. And New York City is one step closer to rolling out a congestion plan that would charge some drivers up to $23 to enter Manhattan's central business district. The toll could take effect as soon as the end of next year. It's estimated the charge would reduce traffic in the district by up to 9%. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
We're all pumped for a happy CPI day.
Will headline inflation ease as expected?
If you get something that comes in much lighter, this rally that we're seeing, we think it will continue.
Instant reaction on Bloomberg surveillance.
That headline CPI figure.
That's going to be a scary number.
That is an upside surprise.
And what it means for the Fed.
The Fed is not about to pivot.
Powell is willing to push this as far as needed.
Inflation in focus today on Bloomberg.
You've got food and gas prices coming down. You've got Biden having a pretty darn good summer. So it's possible that maybe the Democrats' losses will only be 5 or 10 seats in the House. Maybe the Democrats will keep the Senate. But I can't see the House staying Democratic. I think the House will flip.
Greg Villiers had short notice yesterday off the shock of what we saw in the search of President Trump's residence in Florida. We discussed that in the last hour with Emily Wilkins, and we go to that right now before we go to inflation here in near an hour. Emily Wilkins harkens from the Great Northwest, as it was called years ago. There's the upper, the lower peninsula of her Michigan. And off to the west, I believe, lonely and cold, is Wisconsin. We get a brief from Emily Wilkins of what we learned the first Tuesday of this week, where we had elections. Emily, what did we learn in Wisconsin? Always an interesting, twisted state.
Oh, yes. Wisconsin is really going to be one of these states to watch. It is going to help determine whether or not Democrats wind up keeping the Senate or not. You saw Democrat Mandela Barnes win the Democratic nominee. That was kind of expected. You saw a lot of other Democrats who are running drop out and endorse him in recent weeks. He's going to be up against Ron Johnson, the current Republican senator from Wisconsin. He has caused a good amount of controversy in recent years with his remarks on COVID-19. He's also very much much loyal to Trump and has sort of been seen as having very close ties with the former president. Wisconsin, though, it's an interesting state. It is a swing state. It's a state that had elected a Democratic governor, but at the same point, you've seen a lot of Republicans also be elected at that time. And so I think it's going to be one of the ones where we're going to be seeing a lot of money spent, a lot of time spent from now until November.
Well, I agree with the swing statedness of it. After the events of the last 24 hours, how does that affect swing state politics? Does President Trump surge because of Republican outrage over these searches?
To a certain extent, yes. I think Greg Valliere really did an excellent job laying this out in his newsletter, that to a certain extent, what happened yesterday was a bit of a lifeline for Trump. It put him back on the front page of the headlines. The search at Mar-a-Lago really united a lot of the Republicans behind him, including a lot of folks who were considering challenging him for the 2024 Republican nominee. And so Trump is really having a boost right now in the support that he's seen after this search. And that could really translate to some more strength for him and for his brand.
Well, but Emily, there's been a question about how Republicans will handle this, and pretty much across the board, they've had the same kind of message, which is questioning the validity of this type of search. Is it having the same sort of support in the populace? In other words, from the polls, is this supporting some of the Republican candidates that have Trump's backing?
Well, to a certain extent, if candidates are tying themselves to Trump, and many of them are, and Trump's brand goes up, that can certainly be seen as a positive thing for them. At the same point, I would just sort of reiterate that a lot of this election, it's going to be decided upon things like inflation. I mean, the CPI numbers coming out today are going to be really important as to what's going to happen in November. Same thing with abortion rights, given the overturning of Roe versus Wade. Those are kind of going to be the big movers and shakers in the November election. Certainly a lot of folks, they're watching the January 6th. They're watching what's happening with Trump. A number of them might be watching the deposition that's going to happen today. But to a certain extent, those aren't things that the average American thinks about every day, even though they obviously are very important stories within our nation.
And Kaylee, it's already happened here. Emily Wilkins always gets me in trouble. Nathan from Milwaukee tweets in and says, Tom, you're disparaging Wisconsin. We are not lonely, we're cold, which is, I guess, something to consider about Milwaukee and points west.
Important clarification. I would have liked to be cold over the last week or so during this heat wave. Emily, you mentioned the deposition by the New York Attorney General today. How consequential is that for the former president?
Well, we knew that Trump was going to have to sit for this deposition. It was supposed to be last month. It was moved following the death of his first wife. Certainly, this is an investigation that's been long going, but we've also heard Attorney General Letitia James say that they think that they are close, that they have a lot of evidence, that they are ready to actually move from the investigation to the point where there are actually going to be charges involved. And so that's going to be something to look at very closely. You know, there are a lot of investigations going on right now. It's not quite clear what the result is going to be from a number of them. So this certainly seems like one that's nearing the end.
Emily, a difficult question, very quickly here. If the Republicans are the party out of power, do they want high inflation or do they want low inflation?
Well, I think if you asked any Republican lawmaker, they're going to tell you that, of course, they would like inflation to be low. But this is an excellent talking point for Republicans. I mean, they can really sort of pin this on average American, going to the grocery store, going to the gas pump, seeing higher prices. I mean, they know that this is going to be an issue. If you look at the TV ads, if you look at the messaging, you're going to hear about inflation, inflation, inflation from Republicans until now, until November. Of course, then the big question is exactly what are Republicans going to be doing to address inflation if they win the House and potentially the Senate.
Emily Wilkins, thank you so much. Greatly appreciate that as well. And of course, Lisa, you know, my metric here is what Unilever's doing with Marmite, and they're up 11% in prices pretty much across the board at Unilever. I mean, Marmite inflation is a major concern for young Pharaoh.
And for you as well. Yeah.
No, I don't eat the stuff.
You're just stick with Tang. Well, I mean, you are seeing this across the board.
I let Vet Bill sniff it and he walked away.
And he rolled over and passed out. Honestly, we are seeing what we're in earnings across the board, that revenues are increasing, but it's because of inflation. And yes, companies can increase the price.
Yes.
But I was looking at Wendy's, which just reported earnings about 25 minutes ago.
Thank you.
And same store sales were actually lower, even though though the headline beat, and you could see those shares sinking. It's just an example of how people are looking at how much real growth are you experiencing, and there isn't that much. Across the board, you're not seeing real growth. You're seeing inflation-adjusted issues really across the board, to your Marmite point, Tom.
Yeah, well, you know, I'm looking here, Kaylee, at Wendy's. I'm glad you bring this up, Lisa, because I've got a nodding acquaintance this summer with Wendy's. Wendy's.
Well, it is a Wednesday. I have a nodding acquaintance with that too.
Still sees free cash flow of $215 million because of Afterthoughts' endless orders on Seamless. There it is. It's in the report.
I do love a good Frosty, Tom, so I'm right there with Afterthought. I think what's interesting, talking about kind of these inflationary pressures and shifting consumer behavior, did you see the Bank of America data out yesterday on credit card spending actually slowing down in July, which really speaks to what we've been talking about. Rents going up, other costs that people are facing going up. That may mean less discretionary spending.
Lisa, I'm glad Kaylee brings this up. Lisa, this is the back and forth, whether it's somebody looking for quiescent numbers or somebody saying, like Farouk was stunning, that we could see numbers go up.
Yeah, and how much does the Fed respond to one print, especially when it could get revised?
I don't know. Part of the interest here, 1 hour away.
Non-forward guidance later today.
Yeah, we will have to see. We're going to be doing this, and of course, we'll bring you full market coverage after 8:30 as well. Futures right now set up 11. Stay with us. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
When big tech reports earnings.
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they are not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg Surveillance, we welcome all of you. John Farrow off today. Kaylee Lyons in with Lisa Bramwitz. I'm Tom Keene, and here now, coming up exactly on 1 hour to an extremely anticipated complex inflation report. We'll get to that with Marilyn Watson of BlackRock here in a moment. Some good guests. Really looking forward to talking to Michael McKee at about 8:15, 8:16 to dive into all the data and all the mysteries he's looking at as well. The mystery in the data front is simple: a 2-day, 3-day churn to the markets awaiting this key report here in 1 hour. Futures up 10, Dow futures up 64. NASDAQ advances by 0.3%, but I wouldn't make much of it, with a VIX 22.28. In the yield space, it's simple. There is a grind to further curve inversion. Negative 48 basis points is extraordinary on a 2-year yield higher at 3.27%. Let's leave it at that and look at individual securities. Here's Lisa.
Tom, we're about 91% done with the earnings so far for the S&P 500 in terms of the number of companies. And individual stories are fascinating. Let's take a look at some of them. Roblox, we were talking about that yesterday, how people were using fewer video games, in particular kids who actually have other things to do. And you're seeing this across the board with all video game producers. You're seeing those shares plummeting in pre-market trading, down 15%. Those shares are already down more than 50% heading into this session for the year. This is because of a disappointment in the usership, because of the trend that we're talking about. Tesla shares, interesting to see them popping on the heels of the report that Elon Musk sold nearly $7 billion of his stock. So why are the shares up 1.3%? Basically, his argument was he wants to get ahead of some sort of fire sale that he'd be forced to do should he be forced to buy Twitter as they deal with the contract negotiations there. And Coinbase came in with disappointment on the heels of the crypto asset meltdown of earlier this year. Those shares lower by 5%. In other stories that I know, Tom, you are very keyed into, the rights to broadcast the Big Ten, the football games of the big colleges. That is what we are seeing in Disney and Paramount, the parent company of CBS. Disney reports earnings after the bell. Those shares up 0.9%. Their ESPN dropped the rights to stream Big Ten. Paramount Global, or CBS, partnered with NBC to pick those rights up, and those shares up 0.6%. This is really the key debate. How much can the prices for the streaming rights continue to gain, given that cable depends so much on sports for their survival? And I'm very curious for what Disney says about why they were okay dropping that in their earnings call after the bell. At Wendy's, we were talking about down 2.3% after reporting revenues that disappointed, as well as same-store sales in the United States that also disappointed, even though on an adjusted EPS standpoint, they did beat. So, Tom, really highlighting how people are looking under the hood for longer-term resilience in order to figure out where to go in terms of their bets.
Thanks so much. Greatly appreciate that. On inflation now, here less than 1 hour away to this historic report. We're thrilled to bring in Marilyn Watson. Yes, she's head of global fundamental fixed income strategy at BlackRock, but far more, she has parchment out at Cambridge. She did not study with Thomas Malthus, and I don't even think studied with Alfred Marshall, but along the way, she figured out the dynamics of price change within our economy. Marilyn, what's the key dynamic here for President Biden as he looks at this inflation report this morning?
Well, I think certainly looking at this inflation report and the following one as well before we get the next Fed decision at the end of September, I think will be crucial. And I think particularly with the midterms coming up as well, when you look at the core CPI, we expect it to remain pretty strong, not as high as 0.7% month on month in the previous month, but nevertheless, we think it will remain pretty high, maybe 0.5. And I think when you see that running annualized basis at over 6%, that's incredibly high. I think also when you look at the data today, we could see in terms of the headline data, It could come down a little bit in terms of a little bit of a drop in gasoline prices. But when you look at the overall economy and you look at the economic activity, we are starting to see the impact of inflation really coming through in terms of expenditure and other forms of economic activity as well. We're seeing a decline, as we saw in the jobs opening, which still remain elevated. But, employers do have fewer vacancies out there as well. So I think it has a massively fundamental impact on the economy when you look at the prospect for the Fed, when you look at the amount of money that households have in their pockets, when you look at business, investment. I think across the board, it's absolutely key.
When you look at the timeline here, and let's go beyond the hysteria of one report that we're going to see here in 50 minutes. If you take a BlackRock timeline out into 2023, do you just assume price down, yield up for fixed income if inflation doesn't get back to a 2% level?
So we certainly think that inflation will start to decline, and certainly it will soften from here given base effects and a number of other issues. However, there are a number of factors in play that I think are key, and those are both supply and demand. So if you look at energy, you look at the ongoing issues, obviously with the Russia invading Ukraine with that. If you look at food, if you look at the friction still in some supply of goods, when you look at maybe potentially further lockdowns in China, there are a whole range of issues that may serve to keep inflation more uncertain than likely. And I think also that will be one of the key things that we look at when we see Jackson Hole later this month, will be to see what the world's major central bankers.
Yeah, but what does it do? What is your bet on price of fixed income paper? I think it's a major mystery here if price can get a bid in fixed income.
Yeah, so I think in terms of fixed income, the market here is pricing in much more of a negative outlook than the equity market is, for sure. And that's when you see the inversion in the curve that you can see at the moment. That's certainly being priced in. I think at the moment, we expect the yield to remain maybe in a sort of range going through to September. But I think going forward, there is a bid for fixed income, because now when you look at other asset classes, like further down the spectrum, not only in investment grade, but in high yield, you can really start to see some incredibly attractive valuations in fixed income. And I think you are starting to see a bid there for those that you haven't seen for a very, very long time. So I think in terms of pricing, I think, the prices will remain supported by end investors, by pension funds, insurance companies, and any investors who need the yield. But with cognizant that there is, a lot of uncertainty around, the economy going forward.
Marilyn, how much conviction do you have? How much conviction does the BlackRock view have in terms of piling in on top of the trade, given the support that you see for these pricing?
So, we are still relatively cautious given the ultimate outlook and trajectory for the economy, but we expect it to remain relatively robust for the rest of this year. We also expect inflation to soften, as I mentioned, but still to remain elevated and far above the 2% target. So we do have, a decent amount of conviction that if you can find high quality assets that do have a very attractive yield, and we're starting to find more and more of those, when you can really see those assets from a bottom-up perspective, then we do have, some pretty strong conviction that we're seeing some very attractive assets in the fixed income space right now.
What are you looking for?
Much more than we have in a long time.
Yeah, well, I can imagine just based on the absolute yield being a lot higher, but what are you looking for, Marilyn, before you go all in?
So we're looking obviously at the balance sheets. We're looking at cash flow. We're looking at how robust different corporates and issuers are, particularly as we do see this slowdown in the economy. I think that's crucially important. We're also looking at in terms of leverage, things like that. Those are important. But I think also liquidity is incredibly important. So, for us to invest in bonds, we really need to do a lot of analysis and really understand exactly how liquid a bond is, the price we go in at, if something happens in the market, if there's a spike in either direction, if we want to change our positioning quickly, where will the liquidity be then and where will the price be then? So I think there are a range of factors that we need to take into account. But I say we do have a lot more confidence now in terms of, I think, the depth of the market and the yield that we can get. And it's really now focusing on a bottom-up perspective on the quality, the liquidity, and the balance sheets of the company.
Marilyn, finally, we were speaking with Greg Peters of PGIM yesterday, who said spreads are not yet attractive enough in credit for me to be interested. I'm just looking at high yield right now, 432 basis points north of treasuries, they've come in substantially just in the last month and a half. How much do you think those could actually widen out?
Yeah, so they have come in considerably, and I think when you look at what the market is pricing in terms of the default rate and other issues, then I think we are in a pretty benign environment right now. I think you could see spreads potentially widen a little bit when you do start to see a little bit more dispersion. I think the next couple of months are tricky because it's the summer trading months with August, then we have the Fed in September, and we will see a lot more key data coming through that will really, I think, help us to give a much stronger signal on the further trajectory of interest rates, inflation, and also the path of growth and the labour market as well. So I think when we get past the summer, we could start to see more volatility then as we really start to understand exactly the trajectory of the economy. And from there, we could start to see maybe spreads widening a little bit depending on the data set.
Marilyn Watson, thank you so much with BlackRock today. And Lisa, I think that's a terrific insight from Marilyn that we've got to get quote unquote past the summer. In series after series, Lisa, that I bring up on the Bloomberg, we have to remind ourselves it hasn't turned around yet. These are vectors moving upwards, and they continue to move upwards.
And there is a question, as Chris Verone said, sure, peak inflation is just math, but we don't even know if we're going to get that, right? I mean, no one's projecting for inflation to increase from 9.1%. But what if you get an increase in core inflation? What if you don't get any decline at all? What does the market do with that? I mean, honestly, we haven't seen it, to your point, Tom, and I think that's looming large over a very illiquid and uncertain summer.
It's going to be interesting to see. Right now, a little bid to the equity markets. Futures up 10. Dow futures up 62 as well. Kayla Hines, I look at inflation. Again, we go to the political imperative. Brian Deese, I believe, with Lisa and the 9 o'clock hour. We'll bring that to you on radio and television. And Kayla, it's going to be interesting to see as we are mystified by where we are. The White House has to be mystified by where we are.
And they have to message around it. Something tells me, Tom, that the president is going to point Americans to the price at the gas pump and say, but look, it's coming down.
That's a perfect segue. And to Julian Lee, we will speak to him about oil, gasoline, and Dr. Lee's petrol as well. Then we'll get back on the inflation script, including Michael McKee with a brief before that report in 45 minutes. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Former President Trump has legal issues on two fronts. He says that today he'll testify under oath in a New York investigation involving the value of his real estate holdings. That comes 2 days after federal investigators searched the former president's home in Florida. Republicans echoed the assertion that the search was politically motivated. The largest oil refiner in Hungary says it has resolved a dispute that led to a halt in oil flows to Central Europe. European sanctions had prevented Russia from paying a transit fee to Ukraine to let the oil pass through. Now the Hungarian refiner says it has paid Russia's transit fee and oil will resume flowing. Several of Europe's major rivers are running dry, disrupting $80 billion in trade routes. Blame it on an arid summer that has set heat records across the continent. The Rhine has dried up to the point of becoming virtually impassable at a key waypoint. That's slowing down vast flows of diesel and coal. SoftBank expects to post a gain of more than $34 billion from selling down its stake in Alibaba. That will reduce its stake in China's e-commerce leader from almost 24% to less than 15%. The investment in Alibaba was one of the most lucrative in venture capital history. And the maker of the world's iPhones, Taiwan's Hon Hai, posted quarterly profit that beat estimates. Demand for the company's cloud products helped it weather supply chain snarls and sluggish smartphone demand. Hon Hai has been navigating component shortages, patches of weakness in the economy, and COVID-related logistics bottlenecks in China. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. As you look at the company you've created, how do you think you're having an impact on the world for the betterment of the world?
We are by far and away the best positioned entity to solve the question as to what does the human genome mean and how can you apply it to individuals.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Despite the fact that price inflation is so elevated, financial conditions, what have they been doing over the last couple of weeks? Well, they've been easing. So to me, that suggests that the Fed has a lot more room to go. I think the die is cast now for a 75 basis point move at the September FOMC meeting, and they need to leave it on the table for the remaining two meetings this year.
Neil Dutta getting out on the calendar into the fall and the great mystery of what we're going to see when inflation and again how it folds into our lives. Lisa really mentioning this morning the effect on wages and also, of course, what it means for Chairman Powell. I should note that we will attend Jackson Hole to give you perspective there from the world's leading academics on economics. John Farrow's off today, stuck in Rome. Kaylee Lyons with us. The good set. Kaylee, thank you for joining us.
Well, thank you,
this
Tom.
morning. Greatly appreciate that. Lisa Bramwitz and Tom Keene here, 45 minutes away from an important inflation report. Part of that inflation is oil. It's something we're all living here. We're not back to VW rabbits and what we knew in the 1970s. This time is different, but then maybe it's not. Julian Lee joins us now. Oil strategist at Bloomberg barely describes his academics at the London School of Economics and his ability to do the maths of the University of Warwick as well. Julian Lee, I want to talk about the character of oil and a gallon of petrol, a liter of gas, in this inflation that we have. Do you perceive oil inflation as a permanent inflation?
No, I don't think it's permanent. I mean, we've already seen over the last month or so that gas prices are coming down, so that is going to have at least, comparing month on month, that's going to be negative for inflation. Yes, it's up a lot year on year, but I don't think we're going to continue to see it rising. I think that you get to a certain point where higher oil prices start having their own self-correction mechanism, if you like, contributing to economic slowdown, and that tends to bring prices back down again. And I think we will, we will see that happen. I've been through so many of these cycles.
Okay, but Julian, you and I flunked exams at LSE on this. This is what drives our listeners and our viewers nuts. Oil was $2 a gallon. It's now $4 a gallon. Oil's price went up, and people like you say, well, we'll get used to it and the inflation will go away. 100% of our listeners and viewers say that's absolute baloney. Gallon of gas is still $4 a gallon.
Yeah, a gallon of gas is about $4. A month ago, it was over $5. In some places, it was pushing $6. So this is a movable feast. It's a movable price. It's you track the history of whether it's crude oil prices or gasoline prices over the long history, and you correct it for inflation. And yes, you may see some upward movement, and in times very strong upward movement. Yeah. But you also see lengthy periods of downward movement.
Julian, at 8:30 a.m., we're going to get CPI. After that, we're going to hear from the White House at 9:30, and potentially they will come out and say, look, we got oil prices down. Look at how much they have declined over 56 straight sessions. Is it because of the release from the Strategic Petroleum Reserve? Is it because of a decline in demand? Is it because people are just speculating there will be a decline in demand in the face of a weakening economy?
I think probably yes, and yes. All of those things, I think, have contributed. Certainly, the release of crude from the Strategic Petroleum Reserve has had an impact on supplies globally. The concern looking forwards, of course, is that's going to have to come to an end, probably in October, unless it's extended. And demand, at least on the EIA's figures, looks pretty weak for gasoline this summer compared with last year. And I think there are expectations of tougher times ahead.
Well, Julian, to that point, how perilous is it that you have inventories at such low levels from the Strategic Petroleum Reserve at a time when we're heading into a winter of great ambiguity, both with respect to the European picture as well as what happens with zero COVID in China if that comes off and you start to get more demand?
I think we have to bear in mind what the Strategic Reserve was created for and what the situation was like when it was created and through much of its history. This was created at a time when the US was very heavily dependent on imported oil, much more so perhaps than it is now. It was created to deal with a disruption of supplies from the Middle East. Well, any disruption of supplies will affect global prices. It will actually affect the availability of oil in the US much less now than it would have done in the 1970s or almost any time since then. I mean, you just look at what's happening now, the difference between the sort of shortages that we're experiencing in parts of Europe where some refiners and distributors are limiting the supplies that they're making available, and what's happening in the United States where oil is abundant, exports are at or very close to record highs. The Strategic Reserve, from that perspective of guaranteeing the physical availability of oil, doesn't need to be anywhere near as big as it was.
Well, Julian, that's all on the supply side. On the demand side, have we seen any real destruction?
It's always very difficult to say in sort of the very near past. I mean, if you look at demand estimates and even demand history, it's frequently revised, not just weeks or months into the past, but very often years into the past as more data become available. What we are seeing is that some measures of US gasoline demand, for example, suggest that has been coming down over the driving season rather than going up. It's certainly significantly lower than it was last year, at least according to the EIA's weekly figures. We're having downgrades to oil demand forecasts I wrote about this in our newsletter, commodities newsletter yesterday. We've got the new forecasts coming from the International Energy Agency and OPEC tomorrow. I expect that both of those will revise down their demand forecasts for this year and next.
Julian, we've got to leave it there. Julian Lee, thank you so much for the brief here on oil and, of course, here with Brent. Higher yesterday, we got up to $98 a barrel. Right now, Brent crude $94.71. Lisa, I almost teared up there with Kaylee with the microeconomic demand elasticity question to Julian Lee.
I can understand, yes.
You know, I mean, you know, it's like poetry.
Yeah.
You know.
I had a good tutor, Tom.
I honestly love what makes you emotional, Tom. It's something that really is very relatable. I think, though, it is a good question, right? Which is, where is the demand? Do we have any evidence that demand is increased? Yeah, great. You're like, take it or leave it.
This is on, folks, demand elasticity, which is a massive mystery out there. I learned this just as one example from Adam Szymanski and Paul Sankey years ago. Gaming out the responsiveness of an economy to the price of oil is just brutal. It's very tough at lifting. Right now, equities advance up 9, up 12 on S&P futures. 34 minutes from this inflation report. Stay with us.
Companies need to think about how they normalize Blackness and they normalize the Black aesthetic and what it really means to be inclusive. And that means to recognize and appreciate and respect and celebrate all aspects of culture and different cultures. And so it's critically important that we recognize that this is an issue, just as my sisters have said, and make sure that we recognize how that issue shows up in the workplace and how we can be advocates and allies in action to ensure that no person, no Black person in this country feels marginalized or disrespected or diminished in any way because of their hair or their race.
So the challenge is not everyone understands that race-based hair discrimination is a reality. And so we find ourselves constantly educating people, including lawmakers, to ensure that they understand that hair discrimination is racial discrimination. And so we are working collaboratively, the four of us championing this work together, along with the Crown Coalition, to ensure that race-based hair discrimination is outlawed nationwide.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. MasterCard is building on its core business, branching out into new products and services. It's up to CFO Sachin Mehrad to ensure this growth strategy pays off.
The key to being successful in this kind of environment is to have a diversified portfolio.
Chief Future Officer, today on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The difference between missed opportunity
and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
I don't think we're going back to a period of time where you wake up each morning and worry about deflation. I think it's quite the opposite for the next few years.
There's been a significant moderation in prices over the past month.
Consumers have an enormous ability to take on higher prices.
We're still seeing positive news that perhaps equities can still go higher in a tightening environment.
We are absolutely seeing a very disrupted economy begin to heal.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Countdown to a pivotal CPI report. Good morning. This is Bloomberg Surveillance. Tom Keene, John Farrow, Lisa Abramowitz, John out. Kaylee Lines very much in. We are about 30 minutes away from an all-important price inflation index. And how much, Tom, do we get a reaction that is bifurcated with a heavier weight to the upside surprise than the downside surprise?
I don't have a clue on that important question, Lisa. I mean, we're going to parse headline and CPI. Mike McKee will be with us in 15 minutes to go into everything he's read in on. To me, the most interesting point, Lisa, is David Stubbs of J.P. Morgan in the last hour. Take services, take out energy, and take out this new shelter inflation we've got, and where do services stand?
Yeah, and that's what you've been talking about as well. How much is that going to be the source, which is what people were expecting, the pivot away from goods to services? How much has that been curtailed by the lack of confidence? That said, how much does this really move the needle, right? I mean, people are talking about a sudden about face for what the Fed projection is going to be. There's a lot of time between now and September. There's Jackson Hole. There's a whole host of other data that can confirm or rebut what we might get.
I'm going to go back to the immediate, the granularity here that we see, and we have to remember that so many of these series, Lisa, still show what our listeners and viewers feel, which is higher and higher inflation. Let's be clear. It hasn't turned around.
And that's why we're looking at real wages and the fact that they're going more and more negative. Kaylee, as we look toward this report, what are you most focused on to give us a compass for where to go next, how to frame the data and how to frame a Fed response?
I think it's going to be about the core metric, Lisa, which of course is what everyone's watching, but just how sticky this inflation is. Because on the one hand, yes, it would be significant if we do see price growth moderating, if it's not rising as fast. But prices are still going to climb, and ultimately the Fed would still like to get down to 2%. So it's not just about a single data point. It's about how quickly they can get down toward their target and what rate ultimately it's going to take for them to get there.
So, Tom, is it fair to call this CPI Wednesday?
Oh, yeah, it's absolutely CPI. No, there's no question about
And then PPI Thursday, and then University of Michigan Friday. We're going to track that out. It's going to be really fun.
This is a big deal. I mean, what we're going to see in 27 minutes is a big deal today.
I would agree, and we're going to hear from Fed officials as well. Right now, the markets, you know, they are up, but I got to say the lack of conviction is really noteworthy to me. I mean, to me, that's the takeaway. NASDAQ futures up 50 basis, up 0.4%. You've got S&P up 0.3%. Really, just a churn there as you see yields come off a little bit on their highs. But that yield curve inversion, Tom, which you've been talking so much about, very much front and center, sending a pretty severe message.
The last day, right down near 50 basis points. This is a two-year yield higher than the 10-year yield by half a percentage point. We're very close to that right now. But what is amazing, Lisa, is the houses suggesting we could see greater and more rapid curve inversion. That's something new this week.
Yeah, and Bank of America charting that out as well. Brian Nick has been charting that out, as well as how you get to a disinflationary environment that's more comfortable, right? What rate do we get down to, and how does the Fed influence that one way or another? Brian Nick, Chief Investment Strategist at Nuveen. Brian, what are you looking for today, and where is the balance of risks to an upside or downside surprise in markets?
I think the balance of risk when you account for the severity of the response is still to the upside. So I think that if we get a hotter than expected core number, if it looks like rent inflation is not only staying high but accelerating, that's going to mean that the Fed is even more reluctant to take its foot off the brake. We already got that hot employment report last week. If this is just going to add to the evidence that the Fed's not going to be able to pivot to slower pace of rate hikes or even rate cuts by the middle of next year. I think we also want to see confirmation that the headline number is soft as expected. But I think the market's sort of looking through that. I think while the market did see the Fed getting more hawkish as oil sort of took the baton and ran with it and led inflation on the way up, I don't think the market's falling for the sense that as long as oil prices are in decline, the Fed's going to get more dovish. I don't think there's a symmetry there, and I think people have caught on to that.
Do you think, Brian, that the market has reacted appropriately to 275 back-to-back rate hikes and the prospect of a 75 basis point rate hike at the next meeting, followed by 50 basis points, followed by a lot of a balance sheet unwind? Have markets come to this realization, or are people looking over the potential lag effects of those kinds of moves?
I would say as somebody who works in asset management, the answer is yes. But if I was at the Fed, I would probably say no, because the financial conditions indexes that we're tracking have actually gotten easier since the Fed started hiking by 75 basis points and seems likely to do so again in September unless there's a major change in the data. So this is not what I would want to see if I was at the Federal Reserve. I think rhetorically we can expect them to, if not become more hawkish, at least sort of keep the message out there that they're worried about containing inflation. And I think, a 0.5, even a 0.6% core inflation number this morning is going to give them plenty of fuel to do that.
Right, Nick, I want to go to the Professor Kaylee Lines. She's working with David Blanchflower up at your Dartmouth, and Kaylee Lines is all over demand destruction. Does Nuveen see evidence of demand destruction, which is a prerequisite to lower inflation?
In some areas, yes. So if you look at the last 12 months ending in June, we had gasoline prices up 50%, but gasoline consumption, nominal consumption, was only up 40. So there's some demand destruction in gasoline. It's not large compared to the size of the price move that we're seeing. But I think consumers, again, throughout this whole process over the last 2.5 years, this really strange economy we've been in, have been really good at adapting, rotating out of places where prices have been rising, rotating into places where prices have been falling. And so the overall inflation shock, I think, hasn't been as severe as the headline numbers would suggest, because there is this substitutability effect. But if you're driving less out of necessity, or you're having to cut back on your discretionary spending out of necessity to pay for necessities, that's a much different kind of feeling. And that's why I think you see these consumer sentiment readings as poor as they have been.
Well, Brian, to that point as well, what we've heard from the chip makers just over the last several days, talking about a slowdown in demand. They make chips for smartphones and PCs. It shows maybe a shifting of behavior away from expensive electronic devices in the face of inflation. So obviously the print today is going to have implications for the economy and for the Federal Reserve. What is the read through realistically to corporate earnings, especially looking forward, because the second quarter hasn't been that awful?
No, it hasn't. I think revenues have really been the key in the first half of the year. So the biggest risk to corporate earnings is not necessarily inflation in and of itself, but the effect it has on demand. So if revenues are growing at double digits, we're not going to be that concerned about corporate earnings. Seems like they've dealt pretty well with the higher energy increase costs and the higher wage costs. But if revenue dries up, then there's not going to be any place for these companies to turn. And I think that's the key. You talked about real wages a little bit earlier. That is the key. We need to get real wages back up before nominal wages collapse under the weight of a slowing economy. And that's the race that the Fed is finding itself in.
How much do you think the Fed is going to be successful, Brian? I mean, we're talking about threading an incredible, the needle they have to thread is just very difficult. We all talk about how narrow the runway is to a soft landing. Where do you put the odds on this actually working out for them?
Not as high as they were 3 months ago, because we've gotten this high inflation data and we've gotten higher than expected rate increases. And I think the market notion that they're going to be pivoting and cutting by March or April of next year, I think is probably too much to hope for at this point, unless we're in a more severe recession, in which case they're going to be cutting for negative reasons. I think narrow path is the way I would describe it for sure. I don't think markets are currently pricing in a severe recession outcome. So we think there's some maybe in between that soft landing disinflation scenario and the severe recession. And that seems to be what we're at with S&P floating 15% off its highs, credit spreads wider, but not at recession levels. I think that's the middle ground that the markets are at least betting.
Brian, as we go to Michael McKee here in our next segment and all that he's read and studied on inflation dynamics, we need to revisit a pregnant issue, and that is we're at an inflation that is 40 years on. How long till we get back to some form of normal? I mean, is it like when the Chicago Cubs win again? I mean, how long is it back to not 2%, but just a nirvana of normal inflation?
I would settle for just the Yankees winning again, and maybe a shorter time frame there. But I think when we talk to clients and they ask about, getting back to normal, I say the next 6 to 18 months, so end of 2023, I think is still going to feel abnormal-ish, not as crazy as the last 2 years have felt. But I think 2024 is where we want to start seeing 2-handle on inflation and back to a GDP growth rate that feels, not spectacular, but not terrible.
Brian Nick, thank you for framing that timeline. Brian Nick is with Nuveen. We greatly appreciate his ability. I mean, Lisa, Nick survived, economics at Dartmouth with Blanche Flower. And
never hit rates. That's
you get like
basically
a Purple Heart. When you graduate from Blanche Flower's lecture, you get a Purple Heart of some type.
I wonder what Danny would think of his comments. He really was pretty strong. Danny's had a pretty strong view on there being more slack in the labor market and how the Fed is going to move too quickly, sort of going against the grain here politically as well as from the sentiment.
I had the privilege of lecturing to a packed lecture hall, Lisa, with Professor Blanche Flower at Dartmouth. And I'll tell you, it's a little bit intimidating when Douglas Irwin, the giant on trade wars and trade, international trade, is sitting in the front row.
Yeah, well, you're like the elasticity of Tang.
No,
really
all these
strong.
people are way better at elasticity and partial differentials than I'll ever be. We spent a lot of time talking about economic history. And Lisa, seriously, that's the moment we're in here 19 minutes away. This is history that we're living right now.
And what's the historical analog? Is it the 70s or is it 1940s, right? Or is there none?
Don't get me going.
Is there none? Is that what you're basically saying?
It's not Bob Seger. We're not, I don't want to relive Bob Seger from 5 or 6. We got more response from Robert Seger in the 70s than anything else we've done.
Okay, you're going to start singing? No, I think people are saying it's the 40s more.
No, Michael McKee's going to come out and sing as well. We're going to do a duet here on Hollywood Nights and all that.
Everyone's just on the edge.
Futures advance up 17. Michael McKee next. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A few minutes from now, we'll get what's been called the most scrutinized economic report in the world. It will tell us where the U.S. fight against inflation stands. According to a Bloomberg survey, the consumer price index probably rose at an annualized rate of 8.7% in July. That is down from June's figure, but still way above the Fed's 2% target. The CPI is out at 8:30 a.m. New York time. And in New York, former President Trump says he will be questioned today under oath about his dealings as a real estate mogul. The investigation involves claims that the Trump Organization misstated the value of its prized assets for tax reasons. That comes just 2 days after federal investigators searched the former president's home in Florida. Republicans echoed the assertion that the search was politically motivated. China has ended those unprecedented military exercises near Taiwan, but it says it plans to conduct regular patrols in the region. The Chinese began the drills last week after U.S. House Speaker Nancy Pelosi visited Taiwan. Meanwhile, the UK's Foreign Office has summoned the Chinese ambassador to discuss what it calls Beijing's aggressive and wide-ranging escalation against Taiwan. Elon Musk has sold $6.9 billion of stock in Tesla, his biggest sale ever. The world's richest person says he wants to avoid a last-minute sell-off of the car maker's shares in case he's forced to go ahead with his deal to buy Twitter. Musk says he'll buy Tesla shares again if the deal doesn't close. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
cryptocurrencies. Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury. So you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a gray zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Wall Street prepares for the latest read on inflation.
We're all pumped for a happy CPI day.
Will headline inflation ease as expected?
If you get something that comes in much lighter, this rally that we're seeing, we think it will continue.
Instant reaction on Bloomberg surveillance.
That headline CPI figure.
That's going to be a scary number.
That is an upside surprise.
And what it means for the Fed.
The Fed is not about to pivot.
Powell is willing to push this as far as needed.
Inflation in focus today on Bloomberg.
Markets are entirely too comfortable with this notion where it's just going to be a straight line down, smooth and easy, right to the Fed 2%. I still think there's lots of room for volatility, lots of room for rates to move both higher and lower, and credit spreads to be much more volatile.
Greg Peters of PGIM with an important comment there yesterday on what's going to happen here. He was tilting towards price down, yield up in the fixed income space as well. We're going to get to it now, 11 minutes away from truly an historic report, and we're going to be briefed by the guy that knows us best. Michael McKee, yeah, he's Bloomberg economics and policy correspondent, but far more than that, besides the fact he's cut and chiseled, he and I have lived other inflation bouts. This is not the 70s, is it, Michael?
No, inflation dynamics have changed a lot, and the first thing that comes to mind is the energy intensity in the economy. The mileage on cars has gotten much better, appliances have gotten much better, so we use less electricity, we use less gasoline, and so that has a mitigating effect on prices. Right. It's hard for people who are at the gas pump to see, but when you look at inflation-adjusted prices, they're lower than they used to be.
You go through the headline data better than anybody I've ever seen. If it's a partition of goods disinflation, surging goods inflation, it has rolled over, or service sector inflation, quiescent, trend line. It's moved up, but not rolled over. Which matters to you in 10 minutes?
Well, we're probably going to look at services inflation because services is the largest part of the economy. It's also what was missing during the pandemic, and now people have come back and they're starting to take advantage of services, travel, things like that. And the big impact on services is labor costs, and we saw the unit labor costs number rise over 10%, almost 11% yesterday for the second quarter. So how much are services companies able to pass that along and need to pass that along? It's a little bit of a different calculation than trying to figure out what your input costs are at a steel mill. So that's a number to look at, is services price inflation.
Mike, a lot of people have pointed out that before the previous 9.1% CPI print, the White House brought out Janet Yellen, Treasury Secretary, to talk about why, yes, it's high, yes, it's a problem, but they're going to get it down and they're fighting it, and it is, there are elements that are a little less scary. This time we've heard nothing, and some people are taking signal from the lack of discussion from the White House, trying to talk it down ahead of time, saying it's going to be a downside surprise. Is there any credence to this?
I don't know. This could be a Greenspan briefcase indicator. The White House has been trying to manage the public's expectations for economic data, particularly the jobs numbers, and they knew we were going to have a bad CPI just because of energy prices last time. Now we know we'll have a better probably headline number because energy prices have come down, but that doesn't mean overall inflation is going to slow hugely. But that it might be getting into the area of it's a little hard to explain to the public, so we'll stay away from it. If it's a good number, I would imagine you'll hear from the White House.
I'm struggling also with real wages, and I've been talking about it all morning, but how do you message that you want workers to gain share, that labor should be a bigger share of the overall corporate profits at a time when people are worried about both runaway inflation, a wage spiral, but also a cost of living that is getting out of control for a lot of people? What is the correct message? Because you don't want to say, we want you to basically have an effectively lower paycheck.
Yeah, that's a very tough message to send, and the Fed is stuck with that dilemma in trying to say we want to bring down demand so that wage increases moderate, but at the same time, Jay Powell says we want people to continue to get higher paychecks. And so how do you delineate what is the proper amount? I mean, from an economic point of view, you can look at maybe a 3% to 3.5% increase in wages on a year-over-year basis is an acceptable level that generally economists think won't produce a lot of inflation. But again, that becomes something that's really hard for the public to understand in this dynamic. And I don't even mention how hard it is for the administration to talk about that.
On the Federal Reserve and how they're going to read this data, Mike, obviously it's going to be important. That is why we have been talking about it for the last 2.5 hours. And yet we're getting it here on August 10th, which is your birthday. Happy birthday, by the way. Well before the September 21st meeting, we get another CPI print before that. So how much is this really going to influence whether the move is 75 basis points in September?
That will depend on the makeup of it. The headline numbers won't matter as much, particularly the headline number, because it is so heavily influenced by energy and food, and there are signs that both of them are going to start to come down. But they'll look at the core and they'll take that apart and they'll want to see whether we're seeing broad-based price increases. Are those high unit labor costs being passed on through a lot of different industries? If that's the case, they might be leaning towards 75. But you're right, we have another indicator. Well, we've got two, because we've got a PCE at the end of August, and then we've got the CPI in September. And so if there's a trend, we may get another view of how that trend is playing out. And particularly interesting is that the next CPI report in September is during the Fed blackout. So we'll get a response today from a couple of Fed speakers to what they see in the CPI today, but you won't have any guidance in September after that CPI comes out.
On radio, you should see the TV chart of the two-year yield lifting up here. We see that right now with an ever so slight lift here into this inflation report to two digits, 3.28% in the two-year yield. Now, because it's your birthday, does that mean the Braves gift the Red Sox a win tonight? Possibly
I think that's only fair. I mean,
they
had
lost, you know,
they
14
teased
of the
last
last
night. They did
whatever.
not do Kaylee any favors on her birthday yesterday by losing in the 11th inning, but they came close.
Oh, good. Happy birthday, Michael McKee. He'll continue with us here with important coverage of what we see on price change in America. Lisa, we've got to remember that this is not a bunch of mathematical mumbo jumbo. This is a huge part of America flat on their back.
Especially the lower income tiers where it's eating up a bigger and bigger proportion of disposable income, where you have people making the decision between filling up their gas tanks and buying an extra sweater or an extra pair of pants. And how much do we see that continue to pressure margins, which is some of the bear cases going forward, versus alleviate in terms of people pushing back against price increases and getting inflation back down?
Kaylee, one thing off the radar here as we go into this report 4 minutes away is we've barely touched on health care, and yet I hear that percolating in different reports as a study for the end of the year.
Well, and I'm sure that will be a point that the administration is trying to make, Tom, because when we look at that Inflation Reduction Act, we know that some healthcare pricing, drug pricing is included in that. Not so sure economists agree that it's going to have a real, at least near-term impact on the inflation the American people are facing, however.
We welcome all of you to this historic report on the nation's inflation with futures up 13. Stay with us with Michael McKee. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When big tech reports earnings,
Another big day, Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this.
The fact that they're not profitable is concerning.
Is this a company that indicates maybe a recession is coming?
We think it's going to be a major bounce back coming in next year.
Nobody covers tech earnings like Bloomberg, your global business authority.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions.
As you look at the company you've created. How do you think you're having an impact on the world for the betterment of the world?
We are by far and away the best positioned entity to solve the question as to what does the human genome mean and how can you apply it to individuals.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg Surveillance, we welcome all of you. John Farrow out today. Kaylee lines in with Lisa Bramlett and Tom Keene here, moments away from an inflation report, waiting for the numbers across the acclaimed ECO screen of the Bloomberg terminal. And Michael McKee will give us a view to maybe what will be a constructive report.
It's a constructive report, Tom. It comes in better than expected with CPI on a month-over-month basis flat, no change at all. That is down from 1.3% in the month of June, so a major drop in the headline number. The core goes up by 0.3%. The forecast was for 0.5, and in June it was 0.7. So that's an unexpectedly better than forecast report. On a year-over-year basis, CPI is at 8.5%. We'd expected a drop to 8.7 from the 9.1 last month, and the core is at 5.9%. Now, the expectation was it would go higher. 5.9 was the same number as in June. The expectation was it would go higher to 6.1% because pressures were spreading. But this is the kind of news that's going to make the folks at the Bureau of Labor Statistics and at the White House and at the Fed smile a little bit.
Mike, look into the data further here. We'll come right back to you with a big lift to the market. Futures up 1.38%, 57 S&P points. Dow out over 33,000 is remarkable, 356 points, and a solid 2% move in the NASDAQ 100. Lisa, describe the 210 spread with a launch to a lesser inversion.
Yeah, I think that is the takeaway here. You see the two-year yield plunge on the heels of the right kind of downside surprise. You've got a tick back to 43, a negative 43 yield curve inversion on basis points. Honestly, though, how much does this really move the needle when you're still talking about core CPI at 5.9%? And that, I think, is going to be the key message from a lot of Fed officials.
Yeah, a step at a time here. Dollar comes in weaker with finally a 103 print on euro is, well, Michael, the level of surprise here on a fan distribution of all the experts you reviewed. Where are we on that fan distribution? This has got to be right at the edge of great news?
Yeah, as long as you define great news as something that doesn't move that much, because as one of your guests was saying just before we went on the air, this isn't.
But yeah, but come on, the president's going to come out. The president's going to
drop.
come out and say we've launched from 9.1% down to 8.5%. Can the president extrapolate out and say we're going to be at 8.2% or 8.3% in 30 days?
My guess, looking at this, is that maybe he can. Looking at some of the underlying numbers. Now, we don't know what'll happen with energy prices. The war goes on in Ukraine. But at this point, gasoline was down 7.7% in the month. In June, it rose 11.2%. So do we get the same kind of percentage drop? That's hard to say. Food prices went up. Food at home, 1.3% higher. It was 1% in June. Now, we've seen agricultural commodities fall. Yeah. So maybe that will work its way into prices. We get PPI tomorrow. We'll take a look at that. But also, food prices depend a lot on the weather. So you can't say for sure these things are going to happen. But we finally see a drop in used car prices. Been waiting for that for a long time, down 0.4%. They rose 1.6% last month. New car prices up 0.6. That's a tenth lower. And apparel prices, this is one to watch, down 1/10 after rising 0.8 the month before. Remember, all the earnings reports that we've had on retailers, they're all talking about large inventories that they're going to have to mark down to get rid of because people, they didn't get them into the stores in time for the right seasons. So there are discount stores that are going to be putting those things on sale.
Futures up ever more. NASDAQ futures is the roulette wheel, the betting wheel here of the markets, up 2.6%. Lisa, I just extrapolated out a 1, 2, 3, 4 point core CPI trend. This is bogus mathematics, Lisa, but it gets you back to a 2% core CPI in the vicinity of the end of 2024.
Bogus mathematics, what everybody needs on a Wednesday morning. What I'm looking at, though, Tom, you are so right to be looking at the NASDAQ and the S&P surging, and it gets the Fed further away from their goal, right? I mean, how much is this not what the Fed wants to be seeing at a time where they want financial conditions
I like
to tighten,
that idea.
and they want to get it down quickly? Mike, how much are Fed officials going to push back against the sort of belief in a sort of doubling down on the Fed pivot on the heels of this data?
They'll push back on it because this is one report, and as we said, there are several more before the next time they have to make a decision. And you look at some of the other categories in this, it's still got some worrisome news. We're looking at rent of shelter up 0.5% after 0.6 last month, and rent of primary residence up 0.7. The owner's equivalent rent, which is the measure that they look at to see what house prices are doing, up 0.6 after 0.7 last month. So it's still in the shelter category, in the rent category, still going up at a fairly strong pace, and that is going to be a problem going forward because it takes a long time to get that through the system.
Our advantage is Michael McKee will dive into the pages and pages of data that we see in this inflation report for America. To summarize again, a constructive inflation report. Brian Deese with Lisa Abramowitz and the 9 o'clock hour on radio and television with a White House view on that good news. Futures up 67 and the NASDAQ again up 2.4%.
Here's the worst news for you, Tom.
Please.
You probably already knew this. Distilled spirits at home up 0.7
yes,
in the last month after 1/10 in June. So a big rise there.
I heard about that from Michael Pond before you brought it up. Head of global inflation-linked research at Barclays. Pond always diving into the inflation data. Michael, you and I go back to when nobody wanted to talk to you because inflation was boring. Inflation is now less than boring. When do we get back to boring inflation?
Well, first of all, Tom, this was a good report. We could stop there, but we're not going to. You know, this is a necessary print for the Fed, but it's not sufficient. We need to see a lot more. You can think about this print as sort of like the weather. You know, it's better today than it has been over the past few days, but it's still summer. There's still a lot of humidity out there. It's not great. So, you know, it's in the right direction, but we're certainly not there yet.
What will be the bond response to this? Michael, you are expert at the analysis across full faith and credit. What is your government bond theme off a better inflation report for America?
Well, again, what does it mean for the Fed? And what we think it means for the Fed is it makes it more likely that our call will be right for the September FOMC hike of 50 basis points. If we had gotten another strong reading, even on consensus reading going into it, that increased the chance of 75. So for now, we feel pretty comfortable about our 50 basis point call. That's less than what was priced in. So it's not surprising that we're seeing a bit of a rally here with a bit of a steepening in the curve.
Michael, how about that bogus mathematics that Tom Keene was doing, trying to extrapolate out the pace of declines? Can we do that? Is there any linear extrapolation that you're looking at to determine how quickly we go back to a rate that's much more palatable to both consumers as well as officials?
Sure. So as Mike was saying, the details matter. And one of the key details of today's report was that the shelter component, which makes up 40% of core, is still rising at a strong rate. Importantly, that tends to trend. So if the downside surprise was because of a couple outliers that aren't expected to continue, then that's going to not give the Fed any complacency here. They're going to continue to weigh on the factors within CPI that trend. So the fact that shelter component continues to be strong, you can't just linearly extrapolate today's print into even the August print, which we still expect to be relatively strong.
How concerning is it to you, Michael, that the knee-jerk reaction is what we're seeing in equity markets right now? A strong rally, just over, like in 1 minute, just bam, there you go. People are going full risk on. How much would you fade that versus lean into that on the expectation that, yes, we are seeing a deceleration, and yes, we have been past peak inflation?
Well, first of all, it's not surprising. these days when data comes out, the market's reaction, particularly risk-on assets, tend to be good news is bad news. We saw that in the employment report on Friday when we got a really good report, and what that did is raise expectations of more Fed hikes, which isn't good for risk-on assets. So we have a report today that leads to a little bit more less hawkish Fed. I won't say dovish, and therefore it's good for risk assets today.
Michael McKee with us as well. Michael Pond of Barclays with us. If you're just joining us on radio and television, it's a terrific inflation report, a joy for the White House, no question about that. And markets celebrate, up 68 S&P points, 1.7%. NASDAQ up 2.3%, even up more a bit ago. Michael McKee has had a few minutes here to dive further into the report. You were making a joke about spirits at home. That's the degree of granularity you can go to. What's another granular item that sticks out?
Well, one thing I was interested in was what happened with medical care, because we've just had this new legislation that would be passed. Prescription drugs were up 0.3% after a 0.1 gain. That's a fairly high move for prescription drugs. So that's something that could be affected if the administration is able to get something in place to negotiate for Medicare, and if the companies don't raise the price on people who don't get Medicare. Non-prescription drugs up 1.3%. So if you're taking Tylenol because you had too much of the distilled spirits, Tom, you're paying more for that. The recreation component up 0.2. Commodities with declining prices, as we've seen for some time for televisions, video equipment, etc. So some of the inflation dynamics that we are used to are coming into play here.
If you're just joining us on radio and on television to the Bloomberg world, Michael McKee is with us, and Michael Pond as well of Barclays and, of course, Bloomberg. After an historic inflation report. Calendar item, Brian Deese in conversation with our Lisa Abramowitz here within the hour. We've seen markets, of course, surge and continue to surge. S&P 500 a 1.7% move, and critically, the VIX comes in a whole stick. We've walked away from 22 to a more constructive market of 20.69. Kaylee?
Well, Tom, I'm looking at break-even rates as well, not just nominal yields. On the 2-year, we're down 11 basis points on the day, 2.78%. So, Michael Pond, does that seem correct to you that 2 years out from now, we're realistically going to have inflation that much closer to the Fed's target?
We think so. The market is priced for a decent amount of disinflation, and our forecasts actually have even more disinflation, so lower inflation than what the market is priced in. Market's priced for almost 3% inflation, not just next year, but 2 years from now. The 1-year rate implied by break-evens is almost at 3%. So the market's not believing that the Fed has yet done enough to bring inflation down anytime soon. Now, if we look further out, say 5-year implied by the market, that is priced more consistent with the Fed's target of 2%. So the market thinks that over time the Fed will get it right, but it'll take several years, not just a couple of quarters.
Michael Pond, stay with us, please, with Barclays, and Michael McKee with us. Now joining us, we're only doing Michael's today on the inflation show. Kaylee demanded that. Michael Gapin joins us now, head of U.S. economics at Bank of America Global Research. And this is an incredibly important add-on to our coverage in that B of A has a really cautious call on the equity markets and on the bond space as well. Michael, you have my best chart I've seen in 3 days, which is the duration of painful inflation for Americas. Does it really sustain out into next year and even into 2024?
I mean, we think it does, in the sense that it'll take a few years for inflation to get back down to the Fed's target and restoring price stability. We think there'll be stickiness primarily in the area of some of these services prices that, yes, airlines gave us a bit of a relief today, but there will likely be some ongoing stickiness on the services side. Obviously, the very good news in this report is what we saw with used cars. We've all been waiting for some of these durables prices to come down. That would be the next shoe to drop after gasoline prices come down. So a lot of good news in this report, no question at all, but I think we're looking for some stickiness in services to persist.
Michael, let me steal the thunder then from Katie Lyons. She was discussing demand destruction. Do we see demand destruction in this report away from used cars?
Not in this one particular report. No, we see some relief here, right? So paradoxically, the weaker the rest of the world gets, sometimes it helps out the U.S. And in this case, the decline in energy prices and how quickly that feeds through to gasoline prices. And again, if this is the first of successive reports where we could see some reversals in durables prices, that's going to help out the U.S. consumer.
Well, obviously, Michael, the Fed's goal is to get demand down. They also would like to see financial conditions getting more restrictive. And yet what we see with a more than 2% rally on the NASDAQ 100 futures right now is financial conditions actually getting easier. Is a good news report on the inflation front still a bad news report for the Federal Reserve if that is the outcome?
No, I think that the way that I would look at it is obviously the labor market is extremely strong and demand conditions are strong. And as your previous guest, Michael Pond, mentioned, good news there is bad news in terms of what it means for the Fed. The Fed's soft landing outlook is greatly improved if core goods start rolling over, for example. So the softer inflation prints are, the more the Fed can accept good news on the other side of the data front. So, they need these types of reports in order to, improve the likelihood of soft landing.
What's a calendar item on that, Michael McKee? I believe we're in August 10-ish. We're going to get to September 10-ish. There's going to be another report, right?
I believe it's September 13th. I can double check that very quickly.
Fine, but the point is, if we get 2 months like this, how does that change the dialogue for Chairman Powell? Does he take a victory lap?
No, he doesn't take a victory lap. He makes sure that everybody knows that the Fed is still focused on this because it's going to take, just mathematically, and, Michael Gapin could probably give you a better off the top of his head hint than me. It's going to take a long time to get down to where the Fed will feel comfortable in moving rates. They've said they're going to get to neutral or above neutral and stay there even as inflation declines. So they're going to have to get down to 3% or so is what they're hinting before they do any kind of move. How long does that take?
We see an advanced Dow futures now at 433,152 on the Dow. SPX up 71 points and a 2.4% move on NASDAQ 100. Really something. Kaylee?
Let's bring Michael Pond back into the conversation as well. Obviously, we've now had a few minutes to digest this report, yet the moves are sticking in the bond market. Can they stick past today?
Well, what we think was clear in this report, and it's been our view, that the inflation outlook is now much more balanced than it had been. A few months ago, everything was pointing in the same direction of risk to inflation being to the upside. Whether we look at commodities, shipping costs, the dollar, wage growth, et cetera, they're all in the same exact direction. And now it's a much more balanced outlook. Wages, as Mike Gapin just said, the labor market is very tight, and that's coming through in the wage report that we got on Friday, and average hourly earnings as well. So, but on the flip side, commodities have rolled over. You look at copper, palm oil, corn, coffee, cotton, pick any commodity, and it's likely been, off its peak. Shipping costs on a year-over-year basis are down 30%. So energy's down. So you can go down the list. And it's a much more balanced outlook, and that's some of what we got today. But you really need consistency in these reports.
Yeah.
One report is not all it's going to take.
Well, and of course, one report is not all we're getting this week. Michael Gapin, PPI is tomorrow. What's the read-through?
I think the read-through there is, ex energy prices, we're still likely to see, solid underlying price pressures in the domestic economy. So 0.4s, 0.5s, which is kind of where the market is thinking. Later in the week, I think will be really interesting to see if import prices ex-petroleum decline again for the second straight month. That's where our head is around. That's where consensus is. Again, that's to Mike Pond's point. We need to see these types of things coming through. We need to see them on more than one report. Getting a strong dollar to give us some pass-through into import prices in the context of lower trade costs would be very important. But I think we suspect a blend here strong import or strong underlying price pressures, producer prices, but we could get some more relief on import prices.
Michael, what's the number? Michael, I got 5 Michaels with me today. Nathanson's on deck. It's killer. Kaylee, who did this? I mean, I've never had so many Michaels around me in my life. Michael Gapin of Bank of America, what is the single attribute that drives inflation lower from a 9% level?
I don't think that there's one. This is the point. You don't get bad outcomes on inflation like this without a multitude of things happening. So I think we need relief on energy and commodity prices. We're getting that. We need payback on core goods prices. Some signs we're getting that. And then we need moderation in the domestic economy. I don't think it's one thing. I think we need to have advances on multiple fronts.
Tom, if I could add just one more to that, inflation expectations. So the Fed in June was particularly concerned about a sharp jump in the inflation expectation component of the Michigan survey. That's back down now, as is the inflation expectations components of the New York Fed survey, and break-evens as well off their highs. So that's an important factor for the Fed in their outlook for inflation.
Right now, Michael Gapin has to leave us at Bank of America. Thank you so much, Michael Gapin, for dropping by today on this historic moment. Michael McKee with us with Bloomberg Economics, and of course, Michael Pond of Barclays continues with us with true expertise in the fixed income space. Kaylee, why don't you bring in Cameron Kreis, who's synthesizing this? I want to do a major shout out, though, first to Michael Nathanson, who we were going to have Craig Moffitt on, but it's an all Michael show until Kreis showed up. So we had Nathanson on to talk about the media, and we will do that again soon with a giant from Moffitt-Nathanson. Kaylee?
Yeah, record number of Michaels. I'm about to start calling you Michael Tom Keene. But let's get to Cameron Kreis, who has a different name, thank the Lord, who is also parsing this data. Cameron, just looking at the moves we are seeing on the back of this, yields dramatically lower, futures dramatically higher, the dollar dramatically weaker. Is this just a knee-jerk reaction, or is this one that's going to stick off the back of this print?
Well, I mean, ultimately, we're just sort of unwinding a lot of what we priced after the payroll figure, right? You know, essentially that pushed us to 75 for September, and now we've gone back to 50. So I suspect we'll continue to price 50 for September. And yeah, I would think that certainly on the yield front, these moves will probably stick by and large. As for for equities, that kind of remains sort of subject to the ebb and flow not only of inflation and monetary policy, but also clearly there's a sensitivity to growth numbers as well. So if we see henceforth that some of the growth figures are looking quite poor, then one might posit that equities could in turn look a little more vulnerable.
And of course, we could see a fresh catalyst for markets across asset classes later on today when we get reaction to these numbers from Federal Reserve officials. Michael McKee, we're just about 2 hours away from Charlie Evans talking about the economy. Then a little later on, Neil Kashkari will be